Thank you for the opportunity to come and speak to a lot of cooperative leaders. As Hannah said, my name is Brian Briggeman. I'm a professor in the Department of Agricultural Economics here at Kansas State University, and also the director of the Arthur Capper Cooperative Center. So just kind of some quick background on me. As Hannah said, I've kind of operated in this space, thinking about finance and agriculture. And now since I came to K-State, a lot about co-ops. And through this presentation, I'm going to kind of draw on a lot of those experiences and just share some thoughts and opinions that I have for you on what's going on with the outlook. If I was in a cooperative and in particular in the finance side, what were some of the things that I would be looking at? One of the things that I enjoy doing on these outlooks is to talk about interest rates. So before I came to K-State, I was an economist with the Federal Reserve Bank of Kansas City. And so during that time, worked in monetary policy, and we thought a lot about interest rates. And more importantly, how does the global macro, everything that's going on with fiscal policy and then monetary policy controlled by the Fed, how does that flow through and affect us in agriculture, rural America, and then here today talk about co-ops. So just a bit about the Arthur Capper Cooperative Center. That was one of the big reasons why I came back to K-State, was to be the director of this center. This center is a public-private partnership between the Kansas Cooperative Council and Kansas State University. Ooh, I think I got some automatic on there, sorry about that. And Kansas State University, I know why that is. And through that public-private partnership, our purpose is to determine, develop, and deliver research and education for the cooperative community. So we do this through various ways, such as scholarships. I teach a co-ops class here at K-State. We also, as you can see in this picture here, do a lot of executive education on finance and work with CEOs, CFOs. And then do a fair amount of research as well. And some of that research I'll use in this presentation here today. So it's been a real pleasure to work with co-ops. I grew up with a co-op. I'm actually from Kansas. I grew up on a farm in the south central part of the state. My dad and my youngest brother today farm right at about 5,900 acres. We have, I believe, right at 30 different circles that we take care of, and some ownership, some share rent, cash rent, all that. So I grew up on the farm. I grew up with the co-op, but now it's just in a different way that I engage with the co-op. I'm not, driving in to unload wheat or anything like that. I'm here to kind of talk about management and some of the things that are flowing through and impacting us. So as I go through, as Hannah said, if I was there in person, my presentation style is very open, very conversational. So if you have questions at all, please unmute, talk over me. I'll try to do my best to try to stop here and there where we can to address any questions that might come up. And then of course, certainly time at the end. So as we begin to look at, the agricultural outlook, we look at net farm income, and this are projections from the USDA ERS. We saw that net farm incomes have fallen from historically high levels, whether we're looking at net cash or net farm income. That period following the financial crisis, the Great Recession, was a big boom time for agriculture. Many reasons for that helped lift our net farm incomes to historically high levels. But over that time, we started to see those incomes fade. And it wasn't that they fell to historically low levels. It was more coming off of a high and reverting back to the mean, reverting back to that average. That it was tough. It was a difficult time as farmers were having to adjust to that more average level. But since that time, since we've fallen off of those highs, we have crept back up. And in 2020, USDA is forecasting a pretty significant pop or increase in 2020 net farm incomes. I should also say another reason why I always like to start with, kind of the farm economy and what's going on there when I'm talking to cooperatives is our business model. I mean, we are, as grain marketing, farm supply co-ops, we are connected to our farmer just because of our governance structure, our ownership structure, our customers are our owners, which are farmers. So we tend to kind of follow with how farmers are doing. So what are some of the things that are coming at farmers, which is why to start off with net farm incomes. And I'm sure all of you have heard a lot about how government payments are making up a significant portion of that increase in 2020 net farm incomes. You know, you hear the estimates about a third, some are estimating about 40% of 2020 US net farm income will come from government payments, all of which is true. But those numbers are looking more at the aggregate USDA numbers. And if you studied that data, many of those farm households and farmers that are included in that net farm income number, to be blunt, maybe are not how we think about farmers. They're hobby farmers or people who have another source of income that is primarily going into the farm, and the farm is just kind of their side hustle, right? So what I'm always interested in is I want to kind of know about what are farmers doing? How are these government payments affecting what I would consider a farmer member, many of our members that belong to the co-op? And not surprisingly, when we drill down, you can see a pretty wide variation of the importance of government payments to farmers. So what I did was I pulled in some Kansas data that we have, just because I have access to this. Unfortunately, sorry, I don't have for the Corn Belt, you know, through Ohio, Indiana, you know, Illinois, but I have for Kansas just to kind of illustrate this point. So here is a panel set of farmers in Kansas. So the same farmers appear in each of these years, and these are clearly producers. These are folks that, as we think about like our membership within co-ops, these are farmers. And one of the things that you see through net farm income coming from this data, you can see certainly the dip, the fall off of some of the highs, like what we had in 2014 to down into 2016. But I also put in there the portion of that net farm income that is tied to government payments. And then at the bottom to put okay, so of total net farm income, what's the percent that is coming from government payments? And you can see pretty clearly in 2015, it was a rough year in Kansas for many of our farmers. I mean, without those government payments, we had negative net farm incomes on average. So that's rough, right? So that pushed it up, and that made it such a high percentage. But if we look here at 2019, it's pretty sizable. When we look at what happened in 2019 with those government payments that came in, you know, about 75% of that was tied in. Just looking at the size of it, you know, $90,000. And if we look at 2020, my expectation is that we would see another elevated number as well. So government payments here recently have been a significant portion of net farm income. And you add on top of it, they've been mostly on an ad hoc basis. So it's not tied into the farm bill or something that we might expect going forward. So the question that I would have, as you know, we think about, you know, the outlook and how government payments might affect us as co-ops, how are our farmer members utilizing those government payments? What are they doing? Are they going out and having another family vacation? Are they going out and just increasing family living expenses? At least here in Kansas, what I've been hearing with a lot of lenders that I work closely with who lend to farmers, I've heard pretty clearly that what farmers are doing is actually building up working capital, saving. And I've worked with a number of co-op farmer directors here recently. And that's really what I hear a lot of, is building up the liquidity, the working capital, building up their balance sheet, which is a good thing to hear, which is, as me, you know, if I was there being an advisor to these producers, that would be one of the things that I would say you need to start building up, because we don't want to make decisions about investing for the future on the expectation that 75% of our net farm income will come from the government. So at least from what I'm hearing, and I'll make another tie-in for co-ops specifically on this government payment piece. But looking more to structural issues within this net farm income increase, I don't want to be, you know, necessarily all down. I mean, there are some pretty bright spots. You look at lower supplies and higher demand really have pushed corn and soybean prices higher. Here we have here at K-State, we have a website called agmanager.info, where we regularly update, WASDE reports that you have here, livestock reports. So feel free to go to agmanager.info if you want some additional information kind of on ag outlook type stuff. But you can see pretty clearly with those ending stocks in corn, ending stocks in soybeans coming off, and a lot of that has been pushed up. Now, some of that was based off of re-estimates or adjustments to the projection for total supply by USDA, but I'm more interested in kind of some of those more demand-driven events. When we had ethanol, that really boosted corn prices. When we had growing global economies and we're really starting to export a lot more, that demand has that demand pull on those prices, which really can elevate incomes. So that piece, demand, does look fairly positive going forward, and especially in the Chinese economy. So since 2016, China's ending corn stocks have been declining largely because domestic corn production cannot keep up with domestic consumption that they have in China. Well, what that largely then means is we're going to see additional amount of imports from China, in particular on corn. And you see some of those record export numbers that we have for corn going into China. There are a number of reasons for that. One that I like to highlight is repopulation of their hog herd, coming off of African swine fever. Proteins is certainly something that the Chinese economy and consumers are starting to upgrade their diets, and pork is certainly one thing. So that repopulation of hog herd, they need to be fed, and there's just not enough domestic production there. So that has been a boom. We've imported that 6.67 million tons of corn from January to September of this year. Also, sorghum imports have been quite high. I know probably not as much grain sorghum grown in your area, but here in Kansas, it's very significant. We see basis levels at some of the co-ops here have been very wide to the benefit of the producer, even nearing $2 of basis. So it's been a tremendous gain for many farmers and that. So I guess as I look, kind of for this overall recovery in China, following COVID, is looking at their overall economy and especially their manufacturing sector. And we're starting to see that manufacturing sector is picking up. So since April, once they started to get COVID a bit under control, industrial production has expanded every month. So we're starting to see that Chinese economy recover, which is a good thing, especially for agriculture as we look out and how that will affect our incomes going forward. So I would stop there. Is there any questions or comments or thoughts before I move on kind of to some other topics? Okay, so back on that government payments, for co-ops, going to how are those farmers spending it? I ask questions about, well, what does it do for accounts receivable or AR risk for co-ops? We saw when those falling net farm incomes, we started to hear a lot of concerns about AR risks for co-ops. It's been increasing really since 2012. And so what I did was to go in to look at some of the data that I have available, and just to look at, well, what on average are these account receivables that are really past due, 31 days. And on average for the co-ops that I, looking at CoBank data, it's in excess of 550,000. Just so you know, for more what you would maybe consider more normal times, that average sets around 350,000. So it's fairly higher. It has definitely gone up. But if we look at those co-ops that really have rising AR risks, where we see those ARs past 31 days that are really going up in quite high, you look at those co-ops, they're actually a bit financially stronger than their counterparts. So we see higher working capital levels. We also see, on average, you also see lower leverage amounts. So it does give a little bit of confidence, at least looking at how those co-ops are maybe managing through that. I think that's something just to kind of keep an eye on, especially as we are, going into this environment where, will this demand events hold? How are farmers spending those? government payments. How is that going to affect us going forward? Not that I would draw AR risk as a huge risk facing cooperatives right now in the ag outlook. It is definitely something, though, that I would keep an eye on, primarily because of how these government payments are flowing in. The other piece with the outlook is to look at monetary policy and interest rates. And I am going to kind of try to build a case here for why this matters and why it's important about thinking about, how this all flows through and affects us. And then ultimately, hopefully, try to give some, not that I have a perfect answer, I have an opinion on the question for here that could a low interest rate environment persist until 2025. Just to answer it quickly right here up front, my opinion would be yes. We're going to be in this low interest rate environment for quite some time, primarily because signals that we've received from the Federal Reserve, they have thrown a lot of monetary policy, lower interest rates, and even their statements have come out and said for an extended period of time, which for me would be sending signals to the market that it's going to be a while, and I would expect it to be to 2025 and maybe even beyond. We're in really uncharted territory again when it comes to interest rates and monetary policy. So the first thing to look at with monetary policy is quantitative easing, right? So quantitative easing is when the Federal Reserve expands its balance sheet. So they're purchasing securities and assets and adding to it. So the graph that you see here shows the asset side of the Fed's balance sheet. So you can see way at the left, during normal times, before we went into the Great Recession, the Fed would operate at about $850 billion of assets is what they would hold. And I think it's important for you all to know that the reason the Fed would hold those assets is it does not have any tax dollars or anything coming in from the federal government in order to fund its operations. Its operations are funded from these assets and services that they provide. So generating from traditional security holdings, which tend to be government treasuries to help fund, infrastructure building, the salary that I was paid when I worked at the Fed, those kind of things. But in the Great Recession, financial crisis, we saw that balance sheet go up to $2 trillion. Then we heard Ben Bernanke talk about in 2009 that the housing market was misfiring. So we had this red area pop up, mortgage-backed securities that the Fed was buying. 2011, the economy still wasn't going enough. So we started expanding by buying more US treasuries. It went up to 3 trillion. 2013, it still wasn't going. Now we got up close to 5 trillion. And then COVID hit, and now it's over $7 trillion. All right, so this is the non-Fed approved portion of the video. This is when Brian can be a simple farm kid from Kansas and ask this question: what does $1 trillion look like? You say $1 trillion, I'm like, it's $1 trillion, great. So it has a lot of zeros behind the one. But what does it actually look like? So I'll go through a quick thought exercise for you all just to kind of have an idea of what it is. Okay, so this is a $100 bill, right? $100 fits in your pocket, fits in your wallet really easily. No problem. Kind of got an idea of the scale of a $100 bill. So we put a bundle of them together and we can have a $10,000 packet. It's quite a bit of money. It fits in your pocket though pretty easily. Now we're going to put a person in here for scale to look at $1 million. But I could be walking around K-State campus with a backpack and I could have $1 million in it and you would never know, right? But it's $1 million. That's quite a bit, so we got that packet of money down there. Now we start getting some real dollars, right? So now we got to have a pallet. We need a forklift to move around $100 million. So we got this pallet of money. We move into $1 billion. We're getting a lot of money, right? So we got 10 of those pallets sitting there with that person. But when you look at that person, it's like, yeah, that's a lot of money. It's $1 billion, but the person's here. So this is what $1 trillion looks like. That's 10,000 pallets, right? We got that person way down in the bottom corner of the left. And there are 7 of those, over 7 on the Fed's balance sheet. That's quantitative easing. That's a lot of funds that have been pushed into our asset markets and also into our government debt, right? The Fed has bought a lot of government debt. Okay, so the first thing that anybody brings up, and us in agriculture, we are especially mindful of inflation because we remember the lessons from the 1970s because, you know, we had stagflation. So we had an economy that was sputtering, and we had very high inflation, double digits. And we learned how the Fed will fight inflation is they let interest rates rise, right? And that, you know, double digit interest rates that we had in the 1980s, just catastrophic for us in farm country. It was a very, very, very difficult time. So definition of inflation is too much money chasing too few goods, right? 7 trillion is too much money, right? We just saw that. That's a lot of money, right? 7 trillion is too much money. But the Fed's securities and assets that they hold cannot be chased. This money cannot enter into the US economy through our fractional reserve commercial banking system. That would be the chasing. And the reason that it won't happen is the Fed won't let it occur, right? They will not allow these funds to enter into and to be able to be loanable funds. So when we look at this 7 trillion, this isn't a true risk, in my opinion, to inflation. What this shows, though, is the Fed is really picking winners and losers, right, in our overall economy. That red debt area, the mortgage-backed securities, that's a big reason why, I don't know about you all, but I went out and refinanced my home loan. I got a really great low rate. That helps, right? Like if they're out there purchasing that, it helps to lower those interest rates. Treasuries, the orange area that's there, when buying those, like it's helped to push down the yield curve, which has also affected us in co-ops because you look at some of the rates that we can say borrow, for example, from CoBank, those rates are going down, and that has an impact because of buying those treasuries. The one thing, though, that is concerning when it comes to inflation, and you look at this, is that orange area. By definition, when any country's central bank purchases its government's debt, that is called monetizing the debt. And the only reason why you want to do that is you got to create inflation. That plain and simple. You are just trying to create inflation. That's what happens when you monetize the debt. But we still haven't seen a lot of rapid inflation. We just haven't seen it. And when you look at the amount of treasury purchases that is abnormal for the Fed to do, one would say, well, that should stoke some inflation by definition of monetizing the debt. Well, and it has, but it hasn't been that rapid inflation like you might see or expect, like what happened in the 70s. And I have some reasons for that, which I'll get to in a little bit. I heard some chiming in and out, so I don't know. Are there any questions at this time? I can stop here or field any questions if anybody has a question on this. So one of the reasons that we wouldn't expect to have a lot of inflation is the Fed is sending a lot of signals to the marketplace that they're expecting lower long-term interest rates. One way, like I said at the beginning of this part, where they are making that statement that interest rates are expected to be held low, but also back in 2012, in a move for more transparency, the Federal Open Market Committee, FOMC, the FOMC that sets interest rates and debates quantitative easing, started sending out and providing their projections on interest rates, for example. And so what I did, it's called the dot plot. And so if you followed that at all, there are dot plots that you can put out there. And I tabulated over time and I collect them and add them to my spreadsheet. And one of the things that I'm always interested in is how has the trend been for longer term interest rate projections by the Fed? What is it that the FOMC is saying for their expectations for interest rates going 3 years and beyond? And I don't need a fancy statistical model to tell you what the trend is here. It's clearly down. And I think this is important for us as we start to think about the environment we're operating in those lower long-term interest rates, because the old view was where they started in 2012. The thought was coming off of the recession, that the 2008 recession, that we would go back to this 4 to 4.5% interest rates. And that's on the Fed funds rate. So the rate that is overnight lent over between banks. But we thought that was where we would go back to. But as we have continued through since 2012, that has only gone down to where now we might be settling into this, what I would call the new view, is 2.5%. So nearly half. Has that come down to a point where this is where we're going to settle? And if you look at other economies around the world, Japan, Eurozone, other areas, developed nations, they've been in a low interest rate environment for longer than what we have been. So is this something that we're settling into? And what are the implications of that for us? And I'm going to kind of go through some of those, thinking about for us in ag. Well, one is the US dollar, right? So as interest rates come down, we would expect that to have an effect on the US dollar, right? To put some downward pressure so that, and that's good for us in agriculture, because as interest rates come down, US dollar depreciates in value. It makes our goods more affordable in the global marketplace. So we can be more competitive that way. So when we were coming back, off of the recession and we saw interest rates coming up, you can see the US dollar really did take a jump, right? In 2014, 16, 18, we saw that rising, largely because, Fed was increasing interest rates. People were getting more confident within the global economy, and they were, liquidating those assets and moving their money and funds into more risky assets. So we were seeing, that starting to occur. But now we saw a big pop when COVID hit, because there was a flight to safety. Everybody kind of flocked to us, and we saw that big pop, much like what we saw in the 2008 recession. But now it's starting to come off and decline, right? Like China is starting to recover. Things are starting to get better, which can be good for us in ag. And actually, I read an interesting article that if we get a vaccine that works, that can put this pandemic and COVID behind us, could we see a lot of investors flocking out of the US dollar? And if that's the case, could we start to see a big and, a reduction, right, in the value of the dollars? There's just not the demand for it, like what we saw previously when we went into the pandemic. And then as interest rates were coming up, could we see that a bigger decline? So if the vaccine comes in, maybe that could be a good thing for agriculture, in the sense that the value of the US dollar would depreciate, would fall, and because we would see more of that going outside and seeking out other assets. So that's, as I think about it, this could be another good signal. The vaccine not only getting our lives back to more normal, but could be good for agriculture. The other piece for co-ops, and I heard a lot about this, a lot of discussion around looking at variable rate financing versus fixed rate financing. And I think we're maybe going to be entering into a period where those discussions might be coming back, especially if we get a vaccine and the economy begins to recover. So to go through and reflect back on what happened when that was a big discussion, back in 2011 to 2015, was when a lot of this talk was happening, that if you were, as a cooperative, to utilize variable rate financing, there was some significant interest expense savings that you could reap, because variable rates were so low relative to those longer term rates. And one of the things that is reflected in here is the yield spread. So what I have here is the difference between the 10-year Treasury minus the 2-year Treasury. And when that spread widens, right, it's what it indicates is that shorter term rates on the yield curve are lower, which has an effect of pushing down those variable rates relative to fixed. And for some of you all, maybe working at a co-op, and during this time you had a lot of these discussions that this was a period of time that maybe we need to be looking at variable rate financing. I know a lot of co-ops, not just here in Kansas, but outside, that was a discussion, and many of them did that. But going in about 2016, the yield curve started to flatten. Those rates came together, and to a point where variable rates were not as appealing anymore, that it was more looking at fixed rates. And then when we had the Fed push interest rates down to the zero bound, we really saw some very appealing fixed rates that could be locked in at a very low rate for a pretty long extended amount of time. And many cooperatives, as farmers, as consumers, we did that. But if we look here and we look kind of going through this, and if we do get a vaccine, and if we do see the US economy beginning to recover, might that pop back up? Could this be something that could come back to us as cooperatives where we need to start examining variable rate financing? To be honest, if that does come up, I would view that as a good thing, because it is a signal that we're beginning to recover. But I would keep an eye on it. I would monitor those variable rates, especially as you're looking for your financing needs. I don't think it's here quite yet, but as we start to see this spread begin to increase, those opportunities might present themselves again. So on inflation, certainly low interest rates, we talked a bit about that, is, the prospects for future inflation, they have crept up. They are certainly there. For one reason that I showed earlier about the Fed's expanded balance sheet, especially when it comes to purchasing US government debt. But, we need to kind of look at some of what the market is telling us. What is the market sending signals on when it comes to inflation? One inflation measure for expectations, like looking ahead, is the 10-year break-even inflation rate. And if you look at this, this is what the market expects inflation to be in 10 years, if you want to interpret it that way. Certainly it came down when COVID hit and we went into shutdown. We saw inflation expectations drop, but it didn't get as low as what it was in 2008. I think the big difference here for that is in 2008, that was a more typical recession. Like there was a reason, there was something that was driving it that was more structural. There were more issues that were there. So in that case was the housing market, and that had big implications for the rest of the US economy. And there was some real fears about having deflation. It dropped almost down to zero. But with the COVID pandemic, it was literally a shutdown, and then we started everything back up. Now, there are implications for that. But when we look at as far as what the market was telling us for inflation, it bounced back rather quickly, into that 1.5%, just under the 2% mark. So the market at least is telling us that everything that we talked about before, low interest rates, purchasing government debt, it's not a big concern to the market at the moment. The other thing that's out there is TIPS. So Treasury Inflation Protected Securities, or TIPS rate, which just looks at purchasing treasuries less the inflation expectations for the market. So what you see on the left. And if you look at where it actually dips into negative territory, so you hear some people talking about negative interest rates. Well, here's an example in the US where you have securities being traded at a negative rate. So what does that mean? So that means individuals who are purchasing these securities are willing to pay money in order to protect that principal. So they're not protecting the full amount because they actually have to pay a cost for that. And we saw that happen one other time in 2012, and we came above, but that is definitely prevalent right now. So why is that? What is going on? Well, one reason that investors would do that is for fear of future inflation. And I personally believe that was a big motivation for 2012, 2013. We were coming out of the Great Recession. Things were improving significantly. We had a lot of quantitative easing. We still had low interest rate. We started to see a lot of chasing beginning to happen, and some investors got spooked, and we pushed those tips rates down into negative territory. Today, I don't think that's the motivation that you see on the far right. I think a lot of the motivation that is being driven in here to push these rates into negative territory is just a flight to safety. Just saying, look, I am willing to pay money to protect at least a portion of that principal in real terms, because I'm afraid of everything else that's going on in the economy. So we have those tips rates have been entered in negative. But, certainly one, and I've heard other economists make arguments that it is, for fear of future inflation. I personally feel that it's more driven by a flight to safety. So what about future inflation? Me personally, I feel there are some significant headwinds facing future inflation. I would put a, rapid inflation rise like what we had in the 70s. A rapid increase in interest rates, that would be a very black swan type event. So I would put a very, very low probability on that. And a big reason why is just inflation's facing a lot of headwinds. There's no lack of, there's a lot of concern about no core inflation. So looking at the value of goods and services, less the more volatile items like food and energy, is just very low. And a lot of that is because we've had very low real wage growth. If you look at real wages, real salaries, so adjusted for inflation, there just hasn't been much of that growth. And in order to have very high inflation, we would need to see a lot of that, the job market greatly improve, and not only improve in the number of jobs, but the wages that are paid. We just haven't seen that for a number of years. Also is globalization. The United States, we are connected to other countries through foreign exchange, through financial markets, through the global supply chain in ways that we've never been. And that too is also a headwind that pushes down inflation. Also, the economy is struggling. We haven't, taken care of the virus to the fullest extent to where we would see the economy return back to GDP levels that we were before. The market has well anchored inflation expectations. I mean, just look before the 10-year inflation expectation is still below 2%. So the market believes we won't have that. And that's a significant headwind. And right now, the Fed, like what they're saying is they put a pretty low probability on it. So I think all of those headwinds really push down that fear of inflation. All right, but there's still some concerns. So what are some of those signals? Very high US government debt and our very large budget deficits that we continue to run and have run for quite some time. And they're only getting worse through the pandemic. That is very concerning, right? We need to get that under control to stave off, any potential future inflation. Prices of goods and services, have risen, but will they stay elevated? I know like right now with Thanksgiving coming up, we see a lot of the food prices have popped up, but is that more transitory and we'll see that, come back off? That would be my guess. I do feel that if we really fully embrace protectionism and limit our trade options and begin to isolate ourselves more and more from the global economy, that would be something that could stimulate and create a lot of inflation. So not only from an agricultural perspective of having less exports, would that hurt us in ag? It also could be something that if we really laid out and did those protectionist policies, that could spark a big rise in inflation. And of course, negative tips rates that we talked about before. Those are things that certainly could be signals for future inflation. Okay, so concluding comments and kind of some of my takeaways as I look at the outlook for ag and for interest rates. One of the big things is I do focus on the positive, like with ag commodities. I do think the outlook has been brightened, especially from demand. Whenever I'm looking at, increases in incomes and other opportunities, really looking at those demand events is important. And we're starting to see China in particular and Southeast Asia is beginning to do more of that importing, and that's good for us in U.S. agriculture. The question I have is to start to think about, well, how are farmers going to adjust their crop mix, in 2021 based off of these events? Might they do some changes in terms of planting expectations? Could we see some more shift to, say, I don't know, soybeans potentially? Here in Kansas, thinking about grain sorghum, could we see a move from some of those corn acres here, go to that possibly? I don't know. We'll have to kind of see how that evolves. And then also too, I of course said on the accounts receivable risk, how are farmer members using those ad hoc government payments? But also too, with a new administration coming in, how does that affect government payments? How does that affect farm policy and changes that could happen, and maybe even influence the crop mix that we have? So we're going to need to, kind of monitor this, especially early on, to see how those changes will affect. I do think likely continue to 3+ years. I do think 2025 is a reasonable guess for low interest rate environments. Certainly right now, there's an opportunity to lock in low fixed interest rates. But as the economy begins to recover, could variable rates become more appealing? Here recent history has shown that will, be an option that could present itself in the near future. And then finally, there's a very significant need for liquidity. I think liquidity, working capital, it allows us to work. It helps us to ward off any potential risk or unexpected things that might come our way. But also too, it's going to allow for opportunities, to think about what are those opportunities that are going to present themselves, and maybe they already have for your cooperative. Having liquidity, that dry powder available for you to take advantage of them, is a huge advantage for cooperatives that can focus on and build up that liquidity. So with that, I wanted to make sure I left plenty of time, for questions and a discussion. I know we're a little bit smaller group, so hopefully you all have some thoughts, comments, rebuttals. I'm definitely fine with rebuttals. I just got out of a meeting with a bunch of co-op board chairs, and we're still friends. But anyway.
Thank you so much, Brian. Extremely interesting. Lots to think about. What questions can Brian answer? And feel free to unmute yourself and ask, or you can type in the chat function and one of our team members or I will pose the question.
Hey, Hannah, I have a question for Brian. And first of all, I'll just say, Brian, it's been a long time since I did my macroeconomics. So the things that you're sharing today take me back a long ways. But I recognize you focus primarily on the next 5 years or so, 20 out to 2025. Mm-hmm. But going back to that difference at the Fed in terms of the quantitative easing and the chart you showed going from roughly, call it $1 billion up to $7 billion, does that sometime have to translate into inflation out there somewhere in the future? Or did I get the idea that that doesn't necessarily have to happen?
So, Tom, you can think of inflation in this case as the good kind of inflation, right? For our economy to grow, we have to have inflation. It's just they go hand in hand. So the best way to have that balance sheet go back down to from 7 trillion down to about the 1 trillion mark, the best way for that to happen is just to let those securities unwind naturally, right? So instead of using the proceeds as that security matures and take those funds and put it right back into another mortgage debt, or backed security, or a U.S. Treasury, just let it go. Don't use those funds to keep reinvesting. And the Fed actually started doing that right around 2016. And then in 2019, there was some fear because the yield curve began to invert. We were afraid of a recession. So the Fed started reinvesting those treasuries. And then now COVID happened, we're up to 7 trillion. So the best thing to happen for inflation is, that 2%, 2.5% inflation over time. And we just naturally absorb as our economy grows. Now, for that to happen, it's beyond 2025. Like if we were to stop right now, how long would it be? You're probably looking at 10 to 15 years for that balance sheet to get back down to a balance sheet that would be commensurate with a $21 trillion economy.
Good. Okay. Hey, I appreciate that. And I won't force you to try to totally re-educate me in the next 5 minutes, but just one follow-up.
Sure.
All of the government checks that we all got and so forth, and farmers got their ad hoc and the PPE and all of that. Is that related to that increase in the balance sheet at the Fed, or is that simply, budget deficit created that isn't necessarily tied to that increase in the Fed's balance sheet?
No, Tom, it's a good question. They're two totally separate things. So the Fed stuff I talked about is monetary policy that's controlled by the Fed. The government payments, the CARES Act, everything else, unemployment, that is purely on the fiscal side, right? Okay. So that's federal government. So the two are like not connected, but they do work together. Right. Because what's interesting is, the Fed was reacting to the current administration and how they were doing things. So if we have a change in administration, what might the Fed do to change differently? Mm-hmm. Because if we see an increase in spending, increase in taxes, well, that affects the Fed because the Fed is trying to guide our U.S. economy. So they're going to have to react differently. So they're separate, but related through the U.S. economy and how they affect things.
Hey, Brian, in your presentation, you talked about the monetizing of the U.S. debt on there. And normally how that is accretive to inflation. Just curious, in your opinion, if they hadn't done that and we weren't doing that right now, do you think we would be in a period of deflation at this point, or do you still think we would be maybe a zero? Or do you think we'd at least be at zero growth?
That's a good question, Gary. Good to see you, by the way. You always wonder if you actually would enter into a deflationary environment. And I have not seen any studies that would go in, and I'm sure you could do this. I haven't done that, where you could estimate the impact to inflation that those treasuries do. And I could see a pretty, because we're not talking big inflationary numbers right now. I mean, we're, 1.5%. Could it push it to zero? I guess it's possible. My gut would tell me it would probably hover just above zero. But it would be a great, dissertation or MAB thesis. So Gary, come on over to K-State. We got a good program here. So
I'll leave it to you guys. You guys are much smarter than I am.
No, good question though.
Excuse me. Other questions for Brian? We have time for one more, I think.
Looks like
I have a question. Yes, I have a question about deflation. It's also from my macro class. I do remember that deflation is not necessarily bad for the economy.
Inflation or deflation?
Deflation.
Deflation. So when would deflation not necessarily be bad?
Yes.
Well, I'm trying to think through when an event, if we've ever really had. I mean, the event when deflation would be good is that if we had so much excess risk that was taken that we needed to reset the market, at least how I would think about it. And there's certainly arguments out there that we have taken on a lot of extra risk and we do need to reset those expectations. But in general, the fear that I always hear about and I always think about when it comes to deflation is things that happened in Japan, right? Like the lost decade, the spiraling, deflation, that you were in a liquidity trap, that even though all this monetary policy, fiscal policy was being thrown at the problem, they could not get traction and going. And a big difference, and you get this question a lot, like, well, are we Japan, right? Are we in just a trap where we cannot gain traction? I don't think we're there, and I don't know if we ever could get there. It would have to take some catastrophic event for our financial system to implode for that, in my opinion, to happen. One of the big differences between us and the Japanese economy that went through that deflationary period was Japan's financial system is not nearly as strong as ours. It just, don't have the capital levels, do not have the lending function, do not have the, I hate to say it, regulatory oversight, like just the care that is taken and how it flows through the economy. So a big difference between us is that. But yeah, I don't see that happening, and I don't know if we necessarily need that to happen.
Great. Thank you so much, Brian. I'm going to stop the recording now.